everybody, welcome to my finance and accounting education channel here on YouTube. My name is Alex Petrescu. We are now at the 6th episode of my mini series about personal finance. We spoke already in the previous 5 episodes about several topics. The first one was how to build a personal budget with the help of Excel and bank statements. So you need to have a bank account, but you can also do it if your monthly expenses and income sources are cash based. Then we spoke about how to get rid of debt. Moving from debt to wealth was the third episode of this mini series. Then already the fourth one was about how to invest for beginners, so the ground principles. And the last episode before this one was how to invest $1,000. And now, since 47 years have gone since you have invested your first $1,000, you have now, with a compound interest rate of 5%, after 47 years you have gained $10,000, and you are ready to find out now what to do with this $10,000. I'm just telling you that once you are at $10,000, that means you are already on the right track. You will see why in just a few seconds. Investing $10,000, it's, from my point of view, like investing 1,000, only 10 times harder. The advantages, the clear advantages of investing $10,000 instead of only 1,000 is that you can diversify better, of course. The more money you have, the more you can diversify. However, the stakes are higher, so you risk losing a lot more money, exactly 10 times more in this case. You get, at the same time, as another advantage, you get access to different, to other asset classes. You can still invest in the ones in which you could invest when you only had $1,000, and the new asset classes to which you gain access are potentially coming, if you know how to do it, at least potentially coming with higher returns, with higher yields. However, you should also remember that higher returns usually come also with higher risk. It's only natural, and what is more important is that, joke aside, with the 47 years, moving from $1,000 to $10,000, you have probably also gained more knowledge and experience, and you should by now know already what's more things about the economy, your local economy, the global economy, the economic sectors in which you can invest. The asset classes, we already spoke about them, but probably you are now more aware that they exist and how they function, most of them. Yields, economic trends, economic cycles, inflation, monetary policies of central banks, employment, unemployment, and all these things which are surrounding us, and they are very important for our financial well-being. We risk a lot if we have absolutely no idea in what kind of world we are living. Another potential threat which you should mind is that since you have invested your $1,000, per my recommendation, probably in things which are a little bit safer and they didn't brought you that much return, most likely, that you are now like a steed which is just waiting to run, and there is this risk that you go into very risky investments, and do try to maintain to hold your horses, so to say, and to think how much you have to lose in this case, and don't just throw everything on and gamble everything that you have right now, this $10,000. I quoted in the previous video about how to invest $1,000 this video from Graham Stephan, in which he was saying that the average 30 years old American has minus $1,043, and I was telling back then that if you have 1,000, you are already better than the average 30 years old, because you have 2,000 more than his negative net worth. However, by the age of 35, the same American has already $10,400, so you are also in this area. Of course, if you are far older than 35 years old and you only have 10,000, you are lagging behind. If you are under 35 years old, that means you are in a better position than the average American. Then what asset class? We are going to remove some strikes, meaning that last time we said, okay, these classes are suited, the other ones are not. Now we add more to the list of suited ones. It's only natural. So for 1,000, we said that the bank deposits or savings account are qualifying. The bonds also were qualifying. The investment funds, mutual, ETFs were qualifying. Pension funds, insurance funds were not qualifying. Shares were not qualifying, but they do start to qualify right now. Real estate rates were qualifying, so real estate investment trust, they are just like investment funds. So I said that rates are real estate meets investment fund meets stock exchange. However, now you have property as such, so buying a house or an apartment is qualifying now with $10,000 as well, most likely. Commodities and exchange, so trading on exchange rates were not qualifying back then, are not qualifying right now also, but now I think in my opinion that the metals are qualifying because you have more experience and you understand what's going on with the metals. Cryptocurrencies were not qualifying. Now that you have more experience, maybe now they qualify. My personal view is that they never qualify, but that's just me, so you need not be that conservative in your approach, that risk adverse as I am. What stays on the list of why not? So the asset classes that are still not qualifying for your $10,000 are the hedge funds, mostly because we are talking about $250,000, $500,000 or something like that initial investment. So $10,000 is still under the minimum threshold. And since you can only save $10,000, probably you also don't have unless you are a big spender, you probably also don't have the monthly or the yearly income required by them to get you in. So you still don't qualify with your $10,000 for the hedge funds. I'm sorry, I said that this is a playground for rich people, and with $10,000 you are still not very rich. Bad news. Then we have the pension funds. Pension funds and as well as insurance funds, we can put them together, it doesn't really matter. So insurance funds, we are speaking about life insurance, unit-linked insurance, so these plans into which you have to contribute for several years, so usually 20, 25, 30 years. Pension funds, so the private pension funds to which you voluntarily subscribe, and you also have to contribute till you reach the pension age, so to 65 years old. They simply don't qualify because they don't work with lump sums, with just one payment of $10,000. Otherwise, of course, if you can have that financial discipline and do a monthly saving, it doesn't need to be such a large amount. You don't need $10,000 per month or something like that, and you can go into such a program. They are very good, and first of all, they will help you maintain your financial discipline, and you can really reap some benefits at the end of such programs. But they are not fitted with our idea of having $10,000 and what do I do with them. Then, of course, commodities and the fix. I said last time when we spoke about the $1,000 investment, they are mostly for trading, so just speculating. I bought some cocoas or something like that, and I'm selling it with the gain now and things like this, so it's not really investing. With metals, however, is a different thing, so because you can hold for longer periods of time gold, and they are also suited for acting like a treasury element and for holding them. Maybe they are certificates, maybe you buy the metal itself, and I think they are an interesting opportunity. Now, speaking about the appropriate ones, I'm not going to go through all of the ones that I mentioned with $1,000. I mentioned back then the bank deposit or the savings accounts. The bonds I mentioned back then, I mentioned the investment funds, mutual and exchange traded funds, so the ETFs. I mentioned back then rates. And I think that's everything that I mentioned back then. But to this we can already add shares. With $10,000 you can now diversify. You can look into investing in more companies, of course, more sectors, more countries even, and more, because if you are going into countries, if you are, for example, if you are in Europe and you are investing in France, Germany and the United Kingdom, that doesn't really mean diversification, although you have 3 different countries. They are all developed and in the Western Europe, so you should also look in this direction of developed countries, emerging markets, so the BRICS countries and things like this. With the real estate, I'm going to post right now this video. The decision is one of the most complex ones in my, from my point of view. The investing in real estate, many factors to be considered there. Actually, I have done some, let's say, some simulation of how you should evaluate your potential investment, and I just realized recently that I have forgotten, okay, that already had several, let's say, blind spots that I couldn't cover in any way, like development of interest rates in 30 years and things like this that I cannot cover anyway. We have to work with what we know now. I just realized that I haven't included, and I need to update my model as well. I haven't included the insurance for the house, so not for what is inside the house, which you should have such an insurance in case of fire or anything that goes bad with your furniture and the things you have in house. But for the building, once you are the owner, you should insure it in case of natural disaster or something like that. Explosions, they can happen from time to time, and you need to pay this insurance once you are the owner of that house. And also I didn't take into consideration the property tax, which can be higher or lower depending in which country you are, and it's another, let's say, negative cash flow which is adding to your the evaluation of your property investment. Also, do mind the fact that you can most likely use this. Okay, if you can buy a house you are in a country where the houses are so cheap that you can buy one with $10,000 or euros or whatever, it's one thing, but most likely you will be able to use this $10,000 as a 10 to maybe 20% advance payment for a property which is worth between $50,000 and $100,000. But still do mind that this value, especially in areas which are more expensive and so on and so forth, you might pick okay, probably you can have a studio apartment in one of the big capitals, so in one of the largest cities of the world and things like this. But you still need to be aware that with $50,000 you might be buying a property which is cheap because it's not wanted, or it doesn't offer any perspective of value increase, or it doesn't offer, so you cannot get tenants so you cannot act like a landlord and get tenants that easily. So you also need to mind this. You are safer once the value of the house increases, and probably because if the price increase, probably there is more demand for such property, and you are safer from this point of view. So please do not forget to check this video that I just posted. Also, metals, I said that it's a very good idea from my point of view for diversifying. It's considered a safe haven investment, meaning that every time something bad happens in the world, like the financial crisis in 2008, 2010, Brexit 2016, pandemic, so corona pandemic, any other financial crisis that happens, or anything that happens bad with the financial markets, many investors go in that direction and they jump on these metals. Probably that's the moment when the prices are skyrocketing, and of course if you are buying when the prices are low, then you can benefit a lot from placing your money in these metals. Also the cryptocurrencies, they might be suited for diversification, also for diversifying, but you need to be okay with their volatility and having such risky assets in your portfolio. They haven't been around for such a long time. Personally, I don't like them, and this is why I don't like them in 7 bullet points. I don't like them because they don't have an underlying asset, so even let's say the dollar itself has the economy of the United States behind it, and there is no alternative usage for them. For example, if your house, somehow the market crashes completely and your house is zero, so nobody wants to buy it, you have people telling you that they can get your house and they won't pay you anything for it. If you want to give it up, you can still live in that house, so you can still have an usage, so an alternative usage for it. The same is also with gold. For example, if you have gold, you can get some jewelry if it's worth zero. With the shares also of a company, even if let's say Microsoft shares are worth tomorrow zero, you still have all the programs, you still have all the patents, you still have all the clients, you still have all the headquarters, distribution networks. Everything is still there, and you can still get you can still recover something. That's the point. Alternative usage or recovering something. For your cryptocurrency, if it goes to zero, you basically won't get anything. I mean, yeah, this is the way they are working. Then they can be easily manipulated. Remember how the price went to $60,000 plus and then back to 40,000 when Elon Musk expressed his views 2 times about them, namely about Bitcoin. He also said something about Dogecoin, I don't remember exactly. You can also remember that the Security Exchange Commission didn't find him for market manipulation, because they are completely not regulated, and until they become a little bit more regulated, there is no safety against such kind of manipulation, which from my point of view is really quite stupid, that somebody says something about them and the prices explode or they go down, and basically you are playing here with your money. Their biggest advantage, which is presented, and I can understand it, it's also their biggest liability, so their weakest point, the fact that they are non-regulated and they are in limited supply, meaning that the prices can only be stable or grow if the demand increases, but that allows also for volatility, the fact that they are not regulated, so there is no central bank behind them to somehow match the offer of cryptocurrency with the demand for cryptocurrency and keep them somehow stable. Volatility and lack of stability can mean plus, but it can also mean minus, so that's from my point of view another drawback. Also their price increases, so if your wealth is growing based on the fact that you have a lot of money in cryptocurrency, it's only because of this limited supply, so there is nothing else behind it. It's a limited supply, and as many people want those digital assets, let's say, so these cryptocurrencies, the more prices will increase, and you never know when the demand will drop, when the hype will be over, if it will continue indefinitely, so you risk entering the let's say the roller coaster when it's already too late. It can also happen, or not far from being too late. And also what is important for me, that it's a lot, I've also, some people try to scam me over the internet. Okay, they said that they have some videos with me and things like this, and I should pay them in cryptocurrencies. There are let's say a safe haven for illegal activities, so many people that are not doing very good things in the world are using this system to somehow try and do their money laundering, to everybody who was previously doing very bad things with drugs, weapons, human trafficking and so on. Now they can come and say that they are cryptocurrency investors, and all of a sudden their business looks legitimate. And the idea is that the more of so the people that are honest, and the more money we are throwing also in this system, we are helping these guys get higher quotations for their already held cryptocurrency. We are making them rich, and to be honest, I don't want to be part of that. I don't want to support criminals and to make them rich by joining in the same cryptocurrency system. I mean, it's already bad that they are making money from illegal things, but I don't want to make them richer just because I'm greedy. Then you also need to remember this. We spoke when we talk about how to invest for beginners. We spoke about about these points when we talked about how to invest $1,000, but those 3 points are valid, and they are key, and you need to remember them all the time. No matter how much you invest, so 1,000, 10,000, 100,000, 1 million, how experienced you are or not, you can still lose money, some money, all the money, and so on and so forth. So the risks are still there. There is no 100% safe game with investment. Then the past performance does not guarantee future gains. So we are usually looking at the evolution of a company behind. When we are buying shares, we are looking at investment funds, at pension funds evolution, what kind of bank is that, and so on and so forth. But still, that is absolutely no guarantee for the future performance. And also, your main adversary is the inflation. So you want to have a percentage of gain that is always higher than the inflation rate. Otherwise, you are losing money in real times, meaning that with the amount of money that you think you have gained something, maybe you will be able to buy less goods and services tomorrow than you are buying today. So that's in a nutshell the inflation rate. Then my portfolio, talking about myself a little bit, from countries, I'm having assets from United States, from Europe, both Western Europe and Eastern Europe. I'm quite diversified. South Korea and Taiwan, so also two countries in Asia. From asset class points of view, I have investment funds, I have private pension, so I have a private pension fund, I have insurance funds, so life insurance and also unit linked. I have savings account, which is somehow with real estate bound, meaning that I'm saving, it's the closest to a normal saving account or to a bank deposit. I'm saving not a lot of money, of course, just a very small monthly amount of money, and the state pays a premium compared to the regular bank interest rate, so to the passive bank interest rate that I would get for if I would just have a normal deposit. And I should use this amount for either buying a house or making improvements to an existing one, and so on and so forth. So it's somehow related with the real estate. And I also own shares, but that's just the kind of asset classes that I have. I'm considering for diversification rates, and so real estate investment, trust, and metals rates, because I want to tie myself better with the real estate sector, so go into that direction of diversifying. Metals also because I want to diversify a little bit. I tried once buying some gold when there was this opportunity. Unfortunately, the bank with which I was working, and I'm still working with them, probably now they are better, but back then they were not very, let's say, fast. They didn't respond very fast and the way I wanted to my requirement. They didn't understood me. They thought that maybe I just want to get some gold, and I'm surprised they didn't send me to some jeweler and to buy gold from there. I got out of bonds, so I don't really like them. Bank deposits or regular, I still have this real estate related bank savings account, but bank deposits I don't like. I have a little bit of money in current account, but not that much, so it's more like a minimum safe amount. And from my point of view, going into real estate properties too late already. I'm 40 years old. If you check out this video about investing in real estate, you'll see that it's a model which assumes you enter in real estate property when you are 20-25 years old. You will be done with your mortgage in 30 years, so about when you are about 50-55 years old, and then you can really reap the benefits. The fact that you no longer need to pay mortgage or rent by the time you are dead, so till 75-80 years old, so for another 25-30 years plus or minus. So in this direction, being 40 and entering now real estate would mean for me that I would be over with my mortgage when I'm 70, and somebody else will benefit from my investment, let's say. So it's totally not worth it for me. And of course, because I have quite a little bit more than $10,000, I can do even better diversification than you can do with this $10,000 that we have been speaking about in this video. That's it with investing $10,000. Thank you for watching me. Don't forget to like this video if you like it, to share it with somebody that you might think might be interested about the topics I'm discussing here, to comment if you have something to add, and most important, to subscribe to my channel to get regular updates about the videos that I'm posting. I'm posting right now quite regularly. I'm trying to meet the deadline on Tuesday, Thursdays and Sundays. Also, you have some links below this video. You can create an eToro account with 0 commissions and fees for trading. Very good, no matter how much you are trading, you don't pay any commission. 2 offers from Amazon, 2 free audiobooks or audibles, or joining the Kindle program. I also have a Kindle and I'm reading electronic books. It's very practical, especially for traveling. And also probably the option which is most inconvenient for you, there is a wish list through which you can support me with my channel. I need a lot of things. I need a better camera, some light system, a green screen maybe, some software, video editing software, some better video editing software, some Microsoft Office latest version, and so on and so forth. Once again, my name is Alex Petrescu. Thank you for your attention. I look forward to presenting to you next time the next episode from this mini series about basics of personal finance. Goodbye.